Hey everyone, welcome to The Climb. I'm your host, Isaihu Juarez, and today we have another very special episode. Richard Duran, CPA, one of my good buddies and an expert when it comes to tax planning. Today we're going to have a very serious conversation on what tax season looks like, what extensions, different ways to file taxes when you're a business owner, when you're self-employed, the long form, the short form. We're going to talk about it all, but we're going to start with the basics, the fundamentals.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
Richard, thank you so much for being here today.
Well, yeah, thanks for having me again. I appreciate
Yeah,
it.
man. People loved your interview. It was actually the most viewed interview we've had so far. So thank you for taking time. We talked about a lot of things in that episode, and it was a great conversation. It was a great conversation.
I'm glad. When I was in college, I was like, oh, I want to avoid taxes. It's too complicated. But then as I got older and I got into the profession, it kind of came kind of out of nowhere. I would never expect to be a CPA, working on tax planning. But as I got older, I started to realize how important it is and how little everybody knows. So I'm glad you're doing something like this that we can kind of spread the word. And I know you have your expertise, but having that tax part to it, I think will be very beneficial to your viewers.
You're absolutely right, because it's not just how much money you make, but it's how much of your gains you actually keep, right? Like how much of your money do you actually get to save for yourself? So, I talk to my clients about that often. For example, when it comes to trading, we want to be careful because if we're over trading accounts, it could potentially cause unfavorable tax consequences with short-term capital gains, or even scenarios where account could be negative, but people have to pay taxes because of the trades executed. So, it's very complicated. There's a lot of things we got to consider, which is why we want to have this conversation, right? And just to give you an idea with financial planning, the first thing that we do is, okay, let's take a look at your income. Where does it come from? And are there any opportunities to mitigate your tax liability on the receivables end, right? So we're looking at retirement account contributions, any deductions or credits that people. Now, when I say we looking at it, I'm saying we're referring us to CPA or an enrolled agent or some tax specialist to really take a look at this and give us like the best refined recommendations for our clients, right? So, with that said, it looks like we're getting close to the end of what is it, the extension period, correct? When people file for extensions?
Well, for us in my industry, we start doing making sure we're going to complete all the extensions now. We start now. I started tax season last week, working many, many hours. That's why I can't be in your studio as much as I would like to, So I appreciate you at least trying and getting us on a virtual meeting at least, and I appreciate you respecting my time. I really do wish, next time I will be in your studio and we can talk some more. But I think you're right. When you reached out to me and you said, hey, it's extension deadlines are coming up, it might be a good idea to talk again. I think it is really important that we got on and discussed.
So break it down to us. When are people supposed to file taxes? Does it matter if you're an employee versus self-employed? Like how does the actual tax filing process work? And what is an actual tax extension?
Yeah, so if you own a business, obviously it depends on your business structure. But in summary, if you have a partnership, right? If you have a partner and you have an LLC and you guys are both what we call members rather than partners, but we'll use partners and members interchangeably here. Or if you have an LLP, which is also a partnership, or if you just have a general partnership, more than one person owning a business, that tax return is due March 15th of every year.
March 15th.
As also if you have an S corporation, you can be an S corporation with one owner, so that doesn't change anything. So that's also due March 15th of every year. And now C corporations, they're treated kind of like individuals because of the tax code, how it was written a long time ago I think it was the early 1900s. where they try to treat it as a separate individual, like a separate entity. That was our first kind of business structure outside of a partnership. And that's why that's due April 15th,
Okay.
just like individual returns are due April 15th. Now, to add a little bit of complexity, this confuses people a lot. If
Yeah.
you are a sole proprietor, you don't have an S corporation, you don't have a C corporation, that business that you have, and there's a lot of legitimate businesses that are structured that way.
Sure. Sure.
That's also due April 15th.
Okay.
You don't have to file a separate return. You just put it on your Schedule C.
I see.
Now,
And for people who don't know,
Yeah.
what is a Schedule C? So people that don't understand what Schedule C is.
Oh, it's a form that you attach to your individual 1040 that shows your basically your profit and loss. So your income minus your deductions, and then that net amount is what's taxed as earned income plus self-employment income. That just flows back onto what you create the schedule, so profit and loss, and then that number goes and it increases or decreases depending if you have a loss of your income on the first page of the 1040. So there's no separate return that needs to be filed, right?
Okay.
But also, if you have an LLC and you are the only owner, that is also treated the same if you were a sole proprietor without an LLC.
Got it.
So if you recall what I said, if you're an LLC with a partner, then you do have to file a separate return.
Yes.
Form 1065 partnership return. That's due March 15th. But if you're the only member, the only partner of an LLC, it's what we call a disregarded entity. The IRS goes, yeah, it's fine. You're a sole proprietor. We don't really care if you're an LLC or not. So
got it.
The same rules apply to a single member LLC as a sole proprietor. So it goes on your Schedule C, and then it's due April 15th. Now, different states may require, like California may require you to file a separate return, but the IRS does not.
I see.
And not every state requires you to file a separate return. But California does.
Oh, really?
For example. So that's a little extra piece there. And just to make it clear, because a lot of people, at least that I talk to, this is something they don't know, is that an LLC is not related to tax. It's to protect your assets. It's a state enforced entity, right? It limits your liability. It separates your personal assets from your business assets in case you get sued. So, you don't put yourself at risk. But the IRS doesn't care.
Sure.
They only care if you're a partner, if you have another partner or another member of your LLC. But some states do care because you have to pay a fee to the state or tax to the state in order for them to enforce the LLC.
I see.
So I would advise any of your clients or any of your viewers that are planning on opening up an LLC and they're the only member to talk to their CPA, look into if there's any separate requirement just for the state. That's easily missed. I see it all the time. And then all of a sudden they're running their business and they think, oh yeah, I have an LLC, but the state secretly or sent them a letter, they didn't see it, that says, oh yeah, we're not enforcing that. And then all of a sudden they get sued and that LLC does not protect them.
Okay. So let me ask you this. So what about, do you have to follow your LLC in the state that you operate out of or where you live? What are the requirements when it comes to that?
You don't have to. Typically you would, the idea is you would set up your LLC in the city or the state of which you are a resident or the state in which the business is operating, right? That's the general idea. In the past, people used to, let's say, open up an LLC in Delaware, or they'll open up an LLC in South Dakota. And they think that they are being smart. And this used to work. And it was smart back in the day. But a lot of these states are now recognizing that when people do that, they're not, then all of a sudden that state will have to defend them in some lawsuit when it's not even in the same state.
Okay, but why
And
was that a smart move? Like, what were they saving there?
because they would think that if you set up an LLC in Delaware, that they would save. So let's talk specifically about California because I'm in California. That they would
Yeah.
save the $800 tax, right? Which is true if your business is operating out of Delaware.
I see.
So they were thinking, okay, I could save money there. Some people even think, oh, if I set my business up in Delaware, then all of that income is not taxable. But that's not correct because they have nexus rules, which these rules that determine in which district or which state or anything is it taxable. And none of the rules in any of the states say, oh, it just depends where you set up your LLC.
I see.
Now you might be able to get away with it, but then you're risking a lot, right? You're risking the state in which you're actually earning the income. Like say you set up you have an LLC, you have a business in California, but you set it up in Delaware.
Yeah.
And then you're not claiming any of the income in the state of California. The state could find out if they audit you, and then you have to pay all these back taxes and penalties and interest and stuff like that, which can become a mess. You don't want to do that. So the state's starting to crack down on it. Like for example, the state of California now requires you, okay, if you set it up in Delaware, you have to set up a foreign LLC in California.
Okay.
And you still have to pay the $800 LLC tax every year.
Got it.
So that you can protect your business in the state of California, right? And that's another thing that people don't think about. Okay, you have an LLC in Delaware, but you're operating your business in California.
Yeah.
Well, if you get sued in California, what is Delaware going to protect you in the state of California, right? And then California's not going to protect you either. So it defeats the purpose of having an LLC in the first place, which is liability. It has nothing to do with saving you money on taxes getting an LLC. It doesn't. It's about protecting you from your business or business liability,
like
I should say.
Every state's going to have their different guidelines when it comes to what you just said with the registration out of state where you're operating of, right?
Yeah.
Is that correct? Because that's a very specific California example, but I don't know, maybe a different state can have different guidelines in terms of how it taxes and operates.
Yeah, I mean, hypothetically, you might be able to get away with it if you set up your Delaware LLC, but you live in Nevada. Exactly. Like you're not going to pay taxes anyways.
Yeah.
But in that case, why not set up an LLC in Nevada?
Might as well just set it up in Nevada.
Might as well, So these rules, these like loopholes used to be a thing, but they just keep carrying forward. And you keep seeing it on TikTok.
By the way, this is exactly why I highly emphasize the value of having a collective for clients that take a look at this holistically, because you're looking at it from a tax perspective. The attorney who's creating the LLC may look at it from a liability perspective, and the financial advisor is going to look at it from a financial planning perspective, right? So it might take an army to really come up with the appropriate strategy, right?
Yeah.
But one of the things that caught my attention when I was so understood. So LLC is not for tax planning purposes or for tax liability. It's for liability purposes. So then how does
legal liability?
Legal liability, exactly, not tax liability. So then how does the IRS tax LLCs?
So they tax LLCs. So if you're a single member, like you're the only owner and you got an LLC, they tax the same as a sole proprietor. And how they tax that is, let's just say let's just use $100,000 as your net income because it's easy for math, right? Sure. So $100,000, let's say you're at the 25% tax bracket, whatever it's. So, I'm oversimplifying here. Okay.
Hypotheticals. We're doing hypotheticals.
So, okay, you get, you have $25,000 tax liability on your $100,000 of net income on your sole proprietorship or your single member LLC, same exact thing to the IRS. But on top of that, you pay self-employment income tax, right? Okay. which is 15.3%, but you get a deduction for half of it. So I always tell people it's about 8%, right?
Sure.
On top of your 25.
Okay.
But that 8% is exclusively taxed on the 100,000. So if you have wages, you have dividends, you have capital gains, you have all this other income, it doesn't add the 8% to those. It just adds the extra 8 to that 100,000
on the net income from the business.
Right. And the reason why they do that is because you're self-employed. So the IRS is trying to get Medicare, Social Security from your income to fund those budgets, right? The Medicare and Social Security budgets. And since you don't have an employer, they're going to charge you 15.3%. When you're an employee, you look at your W-2, right? You'll see Social Security and Medicare, but that's only half of it, right? That's like 7.65%. So everybody's paying 7.65%. But if you're self-employed, you pay the full 15.3% because it's 7.65% for you, 7.65% for the business altogether. Yes. But then they go, okay, we'll give you a deduction for it.
Okay.
We'll give you the deduction for half of it, which is the business expense, right? So they'll give you, that's what they're deducting. Because if you own a business with employees, you're paying their half, the other 7.65%, right? You're paying that and you get a deduction for it.
Of course.
So if you're a single member LLC or a sole proprietorship, they go, okay, fine. Well, you pay 15.3, but we'll give you deduction for half.
So does that end up being at the end of the day like a wash for the business owner? They're still paying about the 8 point something. No, why not?
No, it's a little bit more. It's because the deduction isn't dollar for dollar.
Oh, right? It's not like a credit.
Yeah, it's not like a credit. So you'll pay effectively more than 7.65%. That's why I say it's about 8%.
I see.
Just to give people a general idea. And so that's how an LLC gets taxed.
Okay.
If you're a single member. Now, if you're a multi-member or you're in a partnership, you have to file a 1065. It's a totally separate return with the IRS.
Okay.
But the taxes are the same, which is any net income that is allocated to you. So if you're 50-50 owner with somebody, you're allocated $50,000 of the $100,000. But that same self-employment tax it applies to you as well as your partner. There is one exception for the self-employment tax, is if you are a what we call passive investor, passive owner, passive owner.
Yes.
So you have to meet certain requirements, right? You can't be involved in operating the business. If you do, it has to be less than 500 hours. They have, it's really complicated. There's actually like all these steps because let's say 1 year you work 400 hours. Okay, I'm passive. The next year you work 750. Okay, I'm non-passive, meaning non-passive, you get taxed that extra 8%. If you're passive, you don't have to pay it.
Okay.
Right? That's because it's not self-employed income anymore. Right?
Yes.
You're passive. You know, so you don't pay that. It becomes kind of like an investment.
Exactly.
So you can wipe that out. If you're a single member or a sole proprietor, I mean, it's self-employment tax regardless, because in the IRS's point of view, it's like you're the only owner.
Yeah, you have to work in the business.
You're not passive.
Yeah.
Right. So these rules don't apply. But when you're a partnership, then you can evaluate year after year. And like I said, I wasn't able to finish, but let's say you work 400 hours 1 year, 750 hours the next year. That doesn't necessarily mean that next year you are going to be hit with a self-employment tax. Mm-hmm. That's when you might want to talk to a CPA and have them go through all those rules to see if you qualify to also be considered passive that year.
I see.
Right. And that's why it's important when you have a partnership to keep track of your hours, and then also a description of those hours, because certain hours apply to that 500 hour limit and some of them don't.
I see.
So having it kind of listed out so you can either provide it to your CPA, or if your CPA asks you that question, then you can give them, and you can save, potentially save
Sure.
a significant amount. I mean, 8% is not nothing.
No, it's okay. So that's based off of net income for the business, right?
Yes.
What about if we take a step back before the net income? What if we look at a business's net profit and before you allocate it either through payroll or through distributions, like, is there a way, like, can you make it a distribution so that you can mitigate your payroll taxes, like a K-1, for example?
Yeah, you can. And the
And
same
what,
thing
and can you
goes.
explain that, by the way? Can you explain what that is? And because I'm using very technical terms, but can you simplify them?
Yeah. So a distribution is just like if you own a business, you could just go to the bank and take the money out, right?
Okay.
If you take that money out, it's not taxable. And the reason why it's not is because the IRS taxes you on the net income of the business, regardless of if you take the money or not.
Okay.
They tax you regardless,
It
right?
doesn't
You
matter
can
what
make
you do with it.
100,000. I'm sorry.
It doesn't matter what you do with it. You made it. It's taxable.
Yeah, exactly. So that made it seem unfair, but it's because the IRS can't sit there and determine and calculate, at least not in the moment, how much of that money that you made did you take out?
Sure.
They don't care. So at that point, they're like, okay, you could make $100,000 in a year, meaning the business net income is $100,000, but you could take out 20,000. You're
Yeah.
still getting taxed 100,000.
Sure.
Right.
Okay.
But the flip side is also true, because you could save all this money, and in 1 year, if you have the money saved, you could take out $100,000 all at once, even if your income is less, and they won't tax you on the money that you took out. So it works in both against owners' favors and in the favor of the owners.
Okay.
So what you're talking about is kind of like what we do, which is the tax planning, is analyzing how to get paid, right? Do you want to take it as a distribution? Do you want to put it as payroll? Do you want to, that's a conversation that you'd have with your CPA. So, I know we've talked
but
about
by the
this.
way, that sounds like that's the benefit of having a CPA versus like someone who's a tax preparer or an old agent. You can actually create a tax plan.
Yeah, exactly. That's the idea, right? It's like, okay, where can we save taxes? And that may change year to year, especially with business owners, because businesses fluctuate in their profitability every year. So talking to a CPA about that is going to help. So now, as far as the distributions are concerned, since they're not taxable, a good idea would be like, well, if you save some money and then 1 year you don't make a lot of money, you can take more out and it's not taxable. So no one has to worry if they are a business owner of going to the bank and just taking money out and putting it in their pocket. They don't have to report that necessarily to the IRS. You have to tell, I mean, it goes on the return, but it's not going to be considered taxable. So you don't have to worry about that.
Okay, so now I have to ask this question. I have to ask because it's from what you're explaining, and I know it doesn't work this way, but I have to ask it. Why wouldn't everyone just pay themselves or just take distributions? Why wouldn't they just only do distributions? I know that's not how it works, but give us an explanation why that's not a feasible strategy.
Well, there's a couple reasons. Well, one reason is what I already explained, which is you're getting taxed on your net income regardless, right? So taking out distributions to save you money on taxes in that regard, it's not gonna help. It's not. Now, there's also a downside to distributions. The IRS, especially recently during COVID, around COVID time, they required this form called the 7203, which is a basis schedule, and that's specifically for S corps, but they also have basis schedules for partnerships as well. And the reason why they have that is because you can take too much distributions. And you might ask, how can I take more distributions? If my distributions are income, how can I take more distributions? Well, it's because you could take a loan, right? For your business, and then turn around and take that money out and go buy yourself something nice. So yeah, the moment that your basis goes negative, what I mean by basis is it's like retained earnings. Every single time the business makes money, basis
Yeah.
goes up dollar for dollar.
Sure.
If it loses money, it goes down. If
Yeah.
the owner puts his or her own money into the business, it goes up. If the business owner takes the money out, that's what we're calling a distribution, it goes
Yes.
back down. So if it goes below zero, it never really can. Anything if let's say your basis is 20,000.
Yeah.
Because that's all your earnings over all your years. It's accumulated every single year. Boom, boom, boom. Because you have $20,000.
Okay.
And you look at your bank account and you have 40 grand in it, and you're like, oh, I'll take 40. I'll take $40,000 out. Well, you have 20,000 basis. It goes to zero. You can't go below zero. So the extra 20 is considered capital gain income.
Oh, capital gain.
So you can get taxed on it, which is another reason why you want to talk to a CPA so that we can take all these complicated things into consideration and let you know, because there's ways around that.
Sure.
You know, if you have the 40,000 and you need it for something, doesn't mean you can't take it out.
Yeah.
You might get taxed for it, or you know, we like what I do sometimes is like, okay, let's just treat it as a loan. The business is loaning you money.
Sure.
You're going to pay it back. You're the business owner, so you can determine the rules all you want. You know, the agreement all you want, as long as it's reasonable.
Yes.
And work on paying it back, and then you can take that 20,000. Like, if it's a loan between you and your own business, it's just putting $1 from one pocket into the other pocket.
Right.
You still have the money.
Understood.
So that I'm not sure if that answers your question, but
no, absolutely does. It absolutely does. Okay. All right. Well, thanks for explaining that part. So, okay. So we talked about a couple of things. We talked about, you know, an LLC or a corporation is not in the IRS perspective is more for legal protection versus a tax strategy, right?
Yeah, for LLC,
then we talked about the LLC. Then we talked about the March 15 deadline, the April 15, right? And the difference whether there's members or it's just single member managed. What about the tax extension? So
sorry,
the tax extension.
We kind of got off track there. Right?
No. This is, by the way, this is great. I think that information is golden. So thank you for explaining that, and even going down the rabbit hole with distributions as well. But so let's say I got that in order, but now I need to file my taxes. I'm not ready to or able to, and I filed an extension. What is an actual extension? Like, what is that? Does it allow me to defer payments? Does it give me more time? Like, how does it work?
Yeah, you know, unfortunately, an extension for you to file your return is not an extension to pay.
Oh, interesting.
So if you don't pay your taxes by April 15th, if you're an individual, March 15th, if you're an S Corp or a partnership.
Yeah.
By the time you file the return, when you basically tell the IRS this is how much tax I owe, and if you owe taxes at extension, like when you file it after you extend it, they'll still hit you with late payment penalties and interest.
Oh, so interesting.
It's always good if you have the liquidity to have a CPA estimate what your taxes are going to be and pay that by April 15th or March 15th, depending on what type.
Okay, so that brings another point. Estimated payments. Who's required to pay those?
Estimated payments, they're required to be paid by people who don't withhold their taxes, which is essentially business owners. Yeah. Right. Or investors, right? Or investors that don't, you know, they get a 1099 dividend for your dividends, 1099 interest, 1099B for your capital gains. None of that gets withheld.
Right.
So you're going to owe tax, but you're not paying the IRS as you earn the income.
Okay.
And the IRS wants you to pay your taxes throughout the year. So this is why when people get paid their W-2, they'll see their withholdings for their federal and their state come out of their account
every paycheck,
because that's going to the IRS in the current year.
Right.
When you file the return next year, you will determine, did I pay too much in taxes, which is you get a refund? Did I
Right.
not pay enough in taxes, which you have a balance and you pay it?
Okay.
But for business owners, there is no infrastructure for like withholdings through payroll taxes
Yes.
to pay your tax throughout the year.
Okay.
So you have to make these estimated tax payments every quarter.
And how
So
are those
that
calculated?
Yeah. So let's just talk about the IRS because
Yeah.
maybe you have some clients in different states.
Sure.
So the IRS, what they want you to do is pay 25% of your estimated projected taxes in the current year.
Okay.
Now that can become complicated. This is why you need a CPA, is because
Yeah.
how are you going to know what your income is going to be at the end of the year as a business owner?
Exactly.
How do you know? So that's when a CPA steps in. You have your books done. What we do is we look at it. Let's say the first quarter, we look at it and we project it out to the end of the year. The IRS allows you to do a calculation, what they call penalty proofing, is what they call it, penalty proof calculation, where you can, as long as you can prove it, that this is how you calculated the income, you can project it out to the end of the year, right? Just
I see.
multiply it by 4, right? A quarter,
I see.
multiply it by 4. And you pay it based off of that. And you go, okay, my expected tax liability is $10,000 for the whole year. Well, you're doing the first quarter. So you only pay 25% of it. So in the first quarter, you pay $2,500.
Okay. And
let's just say the calculation is perfect and it never is. Okay. Then you pay 25% again in the second quarter, 25%, so 2,500 again, and 2,500 third quarter, 2,500 fourth quarter. Then the IRS will consider that you paid your taxes on time.
Okay.
And a lot of people, especially when they first start a business, is they don't know this rule. So they're throwing money away. They won't pay taxes throughout the year. They'll file their return. They'll see that they owe $10,000 all at once. And now it's $11,000 because of penalties and interest.
Yes.
So they could have saved hypothetically $1,000 if they would have came to a CPA to spread out their payments and calculate this estimated tax.
Yeah.
Makes
sense.
Depending on how complicated or complex your business is, the CPA may need to calculate it every single quarter. So that $2,500 I was explaining before may change.
Sure.
Maybe $2,500 one quarter. Oh,
sure.
You made more money. Okay, it's going to be $3,000 the second quarter. Oh, okay, you made less money in the third quarter. Pay $2,000. So it could change.
Understood.
Yeah.
Understood.
And estimated taxes, it's not just a requirement and saves you on penalties and interest. But if you're a business owner, don't you want to know your cash flow?
Of course.
Right? So it's like, come to a CPA, understand what amount of money in your account should be allocated toward taxes.
Yeah.
That way, when you file the return and your CPA says you owe $10,000 and you don't have the money, you could prevent that. You can budget better.
Yeah,
So
you've allocated money. It's basically setting the funds aside.
Yeah, and while you do those projections, I might say, hey, Isaihu, yeah, you owe $2,500. And you might come back to me and say, well, is there anything I can do right now to save my money on taxes? Well, now is the perfect time to do it because the year's not over yet. Of course. Okay. Maybe, hey, go invest in go open up a solo 401k, which you do that service, right? And or go buy a work truck and we'll write that off. Or, I'm talking about, this is where the tax planning comes in. Yes. And you go, okay, cool. Richard, I'm going to go buy a truck next week. Can you adjust my calculation? I go, okay, yeah. You owe $1,500 now. Right. So that's another aspect in which tax planning, projections, quarterly estimated tax payments can work in your favor. Because if you come to me in 2027 and I tell you you owe $10,000 and you ask me what can we do to save taxes, there might not be many options because we don't have a time machine.
Right.
We can't
It's
go
now.
back in time. So it's better to
Yeah.
communicate, especially if you're a business
Proactively.
owner or if you're a high net worth person
Sure.
that has a lot of investments, to contact your CPA every once in a while to hold on to as much money as you possibly can
Yeah.
and budget your cash.
Oh, well, I appreciate that explanation on quarterly tax payments. So going back a little bit to the extension. All right, so it sounds like it doesn't alleviate the fact that you still owe the taxes. So then what's the purpose of the extension?
So so there's a couple of reasons why you might want to extend.
Okay.
The main reason why my clients extend, the
Yeah.
majority of my clients, is because their their business may be complicated, right? So we
Okay.
may need some more time to calculate their net income,
Okay.
to discuss maybe some complex transactions. Um, yeah. So those are the main reasons, right?
Okay.
Now, there are some people who extend because I say, all right, you owe $10,000 in taxes. And they're like, oh, I don't have that money. I'm like, well, the IRS doesn't know you owe that money until we file it. So if you want me to file an extension, I can, but save your money, right? But you're going to have to pay those penalties and
Eventually.
interest for not paying them.
Yes.
But specifically, the extensions are meant to give the taxpayer and their CPA more time to calculate things. So the more complex your business is, don't
Mhm.
be surprised if your CPA advises you to extend it,
I see.
right? And a good CPA will still tell you, hey, look, I know we haven't finished everything, we haven't gone through everything, made sure everything's right, but I did calculate an extension payment for you. Right?
Okay.
A good CPA will still tell you that you're going to pay
Awesome.
something in April 15th.
Yeah.
And then we can work out all those complex transactions to file at the extension,
Very
right?
interesting.
So
Okay.
that's why this second tax season for me is more complicated than the first one. Because the
When's the
first one's
deadline
like
for?
we're filing things because okay,
Sure.
we have all the information we need. There's nothing else we can
Sure.
do. We don't need to do any more research. We need to do any more calculations. We're done. And those ones tends to be the easier ones. So the hard ones are right now for me.
Okay. When is the deadline for extensions?
So for the partnership
Yes.
and the S corporation returns, those are due September 15th.
Okay.
And so 6 months after their original due
Okay.
date. So the original due date's March 15th, 6 months later, September 15th.
Understood.
For individuals, it's the same. So it's April 15th plus 6 months, October 15th, right? What I mean by the same, meaning the duration's the same. 6 months.
The
I
six
didn't mean
months.
it's the same
Yeah.
date. I don't want to confuse anybody. So so it's that extra 6 months that you get to file without getting any late filing penalties. Right. So yeah, those are the due dates. And then of course you have to remember, I know this is going to be confusing, but
No,
you may
throw it out
also
there.
need tax planning throughout that year, right?
Right.
By the time October 15th comes around when the taxes are due, you already had first quarter,
Oh,
second
sure.
quarter, and third quarter of the current year.
Yes.
So
Yes.
this is also why you need a CPA so that we can differentiate those things and go, okay, well, here you have to make a first quarter payment, a second quarter payment. Oh, you have to pay
Yes.
your extension payment. Oh, now you have to pay, right? We calculate these things for you to try to make it as easy as possible.
It sounds
it's
like you guys are
complicated.
busy. You guys are very busy people all year long doing something.
Yeah,
Honestly.
well, so are you, man. So are you in different ways, right?
Yeah.
When numbers are involved, it can get a little tedious, right? So,
Awesome.
so yeah, that's how it works. Did that answer your question?
Yeah.
Okay.
I think because there's a lot of questions right now around extensions, right? And I think you clarified that, right? It's specifically with people thinking that by filing extension that they don't have to pay till October 15. Now you explained there's potential penalties and interest.
Yeah.
So I guess the next move is for people to really understand how do they need to file, right? Like, are they a business owner? What type of business do they own? Is it member managed, single member managed? Are they in W-2s? Do they do the short form, long form? There's a lot of questions, right? Which is why we always emphasize working with a tax specialist, even though it might be a little bit more expensive than like your tax preparer that legally cannot give you tax advice, right? They can just fill out forms. But it seems like if you really want to optimize your tax planning, you need someone that has an understanding and expertise on how to navigate this entire complexity of the system, because not only are you dealing with the IRS, but you're also dealing with the state governments, right? And that can also vary from state to state. So thank you, Richard, for taking a little bit of time explaining the basics, because it's just the basics, right? Like then we can get into the this is just like the general rules of how the filings work. Then, but we would love to have another episode where we get into the details a little bit more complicated than this.
Yeah, like your question of when to optimize distributions versus other forms of payment, that could be a whole episode on its own.
Oh, sure.
Just that, right? The whole concept of basis can be explained in a whole episode. It depends how detailed you want to get. But it's,
how complicated is that? Like, how complex is the tax code, and how often does it change? I'm just curious now that you bring that up.
Oh man, I mean, what is it? It's thousands of pages or something. And the thing is, and it's constantly being changed. For a while there, I want to say 20 years or more, the tax code really didn't change much. Like they may increase things by inflation and adjust things here and there. Sure. But without getting too into this, but COVID, inflation, war, all these things cost money. So the government's trying to figure out, how are we going to fund these things? How are we going to grow GDP? Right. So it's been changing basically since 2018. Right. Well, the moment that Trump became president and changed the tax code, and then Biden, and he changed some stuff, and then Trump came back again and changed it again. It's just constantly changing. It could change every single year. Just depends on whenever there's a new bill that's passed.
Sure.
So understanding these things is important, and it can be overwhelming for most people. They may not even know where to look. So Google AI will help you, but it won't help you interpret it. You still need somebody that has experience to say whether or not you're qualified, because you may not even be able to ask AI the right questions to see if you are qualified. That's just one step. That's just one step better than watching TikTok and saying, oh yeah, if I open a trust, and then if I do this, and then if I, then I'll never have to pay tax. No. Like, this is what rich people do. And you're like, but you're not rich. Right. So it may be true, but you're not rich.
Yes.
Like you may not be able to do these things. So interpreting these things is really important.
Right, because then you got to understand the progressive tax system and the difference between marginal rates and effective tax rates. I mean, there's a lot of things here, right?
Yeah.
With all that being said, how do we get a hold of you? How do we get a hold of your company? Are you taking new clients? Because I'm sure people are interested in getting more information and potentially working with you.
Yeah. Well, I'm a partner at IDL Certified Public Accountants. We're located in Los Angeles. We just are growing by word of mouth. So things like this is good for me, because now I'm getting my expertise and my voice, my business out there. Yes. Which I've been very lucky that I could grow my business just by word of mouth so far. I still need to work on the marketing and stuff like that, but you could reach us. You could reach my office line. We have a website. I know that you refer clients to me. Yes. I'm working on following your lead, Isaihu, and trying to get some social media out there. Sure. And yes, we are taking on new clients.
Okay. Give us all those numbers. How do we? Oh yeah. What's your website? What's your phone number? How do we? Give us the details.
Yeah, website is D as in dog, L as in Larry, dash CPA.com. They'll give
Okay.
you all our information is on there. You can call
Okay.
our office line, 818-963-9445. You know,
Can
you
you
know,
give
wish
it
we
one more
had
time? Can you give it one more time?
818-993-9445.
Okay, perfect.
Yeah. So those are the main ways you can reach me, or call Isaihu. And be like, hey, what's
Richard,
Richard's number? How do I reach
it,
Richard? He's in the dark ages. He needs to get on social media.
no, you guys, no, you guys, you've been doing this for a while, right? Your partners have been in the industry for a long time. Obviously, you guys are trusted CPAs. That's why you're able to grow organically. I've worked with you for quite some number of years now, and you've serviced my clients and not just my clients, my firm, and me as a person, but I would say compare options, okay? But I am a big advocate of the service that you guys do for your clients, because you guys are very detail oriented and really help people navigate the complexity of the tax system. So thank you for doing that. I look forward to having future conversations. And yeah, man, I thank you for taking a little bit of time of your day to, especially right now in the middle of, you're gonna get ready to get really busy. So we just want to appreciate your time. And anything you want to close this and say something to the audience before we sign off?
Yeah. Something I tell people a lot is no one wants to pay taxes. Nobody does, right? But you have to. So I would say do it the right way. And it's
Right.
hard to determine the value of a CPA until things go wrong, right?
Yes.
So yeah, like the first year you come to me, I might be able to find these ways to save you taxes, and we just keep that same structure going, and I can help you. But I'm always going to be telling you, you owe tax, you owe tax, you owe tax, you owe tax. And it's like, why am I paying this guy to tell me I owe tax?
Mhm.
And it's because we can do these tax planning things. And even if we do these tax planning things, you're still going to pay more money. But it all has to do with budgeting. That's what we're here
Yes.
to do. Budgeting, helping you grow the company, and making sure you're compliant with the government, because the government can literally just take your money out of your bank account if they wanted to.
Yes.
You don't want them to do that, right? You don't want them to come back with all these penalties and interest that you didn't know because you're trying to save money, right? So everyone's situation is different. I may not be, cost effective for everybody. You may not need me at the moment. The extent in which you need me may vary as well, even
Sure.
from year to year.
Sure.
But don't disregard the value that a CPA can provide, right? You don't want to get into some issue and then call me, and
Right.
now I have to pick up all the pieces. So not only are you going to owe the IRS and the state, but now you're going to owe me even more because I have to go and pick up the pieces.
Yes.
And
Yeah.
no one wants to do
Fair,
that.
fair
No one
point.
wants to do that.
Fair point.
So I just want people to understand that taxes are one of the biggest expenses that you have. So if you manage your money with Isaihu, you might want to be able to manage your taxes as well.
Well said. Well said. And I appreciate you again taking time. Same thing for me. When I'm navigating clients' accounts, one of the factors that we take in consideration when buying and selling and trading accounts is a tax consequence. And the best way for me to really understand what the potential tax consequence is by having a relationship with my client CPA that can say, hey, we have some carry forward losses, or we have some gains that are being realized this year. We sold some real estate. We received an inheritance, whatever it may be, right? So that I can really identify or understand the consequence of me buying or selling positions from my clients' accounts. So that's why, again, one last time, I really see the value of working with a holistic team that takes a look at the whole picture, not just from one angle, so that we can give the absolute complete advice that our clients deserve and need, right? So with that said, Richard, thank you again for being part of this episode. We'll see you guys next time here at The Climb.